Welcome back. You're watching us here on Halftime Report. The stock on our radar is Honasa Consumer, the owner of Mamaearth, listed a couple of days ago. From its listing high, the stock had corrected almost 30-odd%. But if you just take a look at the intraday chart, you would realize that the stock has rallied a big 20% from the lows and has currently moved just about into the green. What could the reason for this rally be? Well, it's the first brokerage initiation that has happened on this counter post-listing, and it is Jefferies which has written, and they've initiated coverage on the stock with a high conviction buy and a target price of 520 rupees per share, which is a good, a 60-70% upside from current levels as well. What are their growth drivers? Diversification of revenue, 33% coming in from non-Mamaearth brands and 33% coming in from offline sales. If that diversifies, the company can grow at a 27% revenue CAGR over the next 3 years, in line with what the management had guided as well, at least 2 times the beauty and personal care industry. The important driver will be the margins, for which Jefferies expects the margins to be double-digit by FY26, and as a result of which they value it at 6 times FY25 price to sales, which is pretty much in line with all the other beauty and personal care peers, along with Mamaearth here too. The target price of 520, but to that there are a couple of risks, and that is important to be put on the table as well. The first one, excessive competition coming in from large FMCG companies. Second, as is what we've seen with a lot of these new age companies, they do aggressive M&As as well for growth. And the third one is lack of scale up in their newer brand. So if any of these risks play out, then that could be a downside risk, but otherwise it's a high conviction buy.
Okay, all right. A strong recovery for the stock on an intraday basis. We need to take a short break, but on the other side, we'll be talking to the management of Kaplan Point Labs that came out with their Q2 numbers. More on that in just a minute.